episode of Policy and Profits. I'm Antoni Esposito, founder and CEO of Ascalon 6 Capital. I am joined once again by my friend E.J. Antoni, Chief Economist at the Heritage Foundation. E.J., good morning, good afternoon, good night. How are you, and how is the week going, my friend?
Oh, it is a red hot week in terms of inflation. We got CPI, we got PPI, both were ugly. So that's been those have been kind of the highlights or lowlights, depending on how you want to look at it, I suppose. Obviously, we've gotten a slew of other economic data, but they're really the ones stealing the show. It's everybody's focused on prices, and this is all fallout from the Iran war. It's the higher oil prices and that bleeding over into everything else.
Yeah, we were making progress, right? As we came out of, let's not forget Joe Biden, and we were making progress on inflation. And the Iran war has been definitely a monkey wrench. We had CPI year over year come in at 4.2%. And then we had PPI today come in at, well, I guess final demand year over year at 6.5, a little bit of a push up, or the market took some solace in the fact that ex-food and energy, we were 4.9 versus 5.4. So we had two consecutive 4.9 prints because there was an adjustment to the last one.
Right.
What I want to ask you flat out, these are hot prints, and the market is looking at them as it does. It's just ignoring them. But CPI prints greater than 4%, historically, traditionally, we're heading towards recession at that point, or right? Aren't we? Is that? Am I wrong in that, or is that basically the dividing line between recessionary and inflation level that could lead to recession or not? Is it 4%, or am I misreading?
No, you're right, Anthony, because as we hit these upswings in inflation and you get over 4%, that's never the end of it, right? And sure enough, we're very, very likely gonna go higher as we continue to take different estimates, whether those are coming from private groups like Truflation or public groups like the Federal Reserve Bank of Cleveland, looking at their inflation nowcast that they have. And in all those instances, again, you're looking at inflation is still trending upwards, and so at some point, that is typically met by tighter monetary policy. And it is the tighter monetary policy that usually will pop that bubble ultimately, as people can no longer have the same kind of access to easy credit, and you start deflating asset bubbles most often, whether that was the dot-com bubble, the housing bubble, what is it now, an everything bubble, I suppose. But in each of those instances, right, you have monetary policy that's way too loose that helps fuel those bubbles. And then when the Fed takes away the punch bowl, as they like to say, the bubble is going to come back, is going to collapse, and things are going to come back down to earth. So no, you're absolutely right. You do typically see recessions follow from where we're at right now. Now, look, things are obviously really weird after COVID. You should have had a massive recession given how high inflation went under Biden, right?
Yeah.
But the fact is, the Fed just didn't rein it in. They never did. I mean, Jerome Powell left the chairmanship, and he never got inflation back to the 2% target. So, ultimately, I think the Fed was met with this trade-off of, do we allow the economy to go through its natural healing process of a recession, and capital gets reallocated back from waste to efficient resources, or do we allow the inflation to just continue? And clearly, they chose the latter, and we are still there now. It's less a function of the Fed's rapid growth of the money supply today as it is. It's just an oil shock.
So what does Warsh do here? I mean, we have the conversations going. We had obviously the ECB today raised rates, but their benchmark is much lower than ours. First of all, I think they're in the 1.75 range now, and we're at 3.75, right, as far as the benchmark rate. I might be wrong on the ECB rate, but they did raise 25 basis points today. They don't have a dual mandate, so they're not worried about employment and price stability. They're just worried about price stability. So whatever. And I sound like I'm giving them a ton of credit too, which I don't mean to. I apologize. But what does Warsh do here? Can he come in and make an argument to actually cut rates? I don't believe he can. The only argument I've heard him try and lay the groundwork for is that AI is going to be so phenomenal that it's going to actually increase productivity and draw prices down, which the derivatives of thought there are too much for me to wrap my head around. What does he do? It seems like we're pricing in upwards of 1 to 2 cuts in the coming 6 to 12 months. Is that what has to happen here based on what you see, and what would prevent us from being in a rate hiking situation?
I mean, the crazy thing is, Anthony, and I know the betting markets are different from like Fed funds futures and a whole host of other metrics. But if we look at things like Kalshi or Poly market, a lot of those actually have the odds of a rate hike before the end of the year at over 50% right now.
Yep.
So again, it's a betting market. I understand it. It's fundamentally different from how some of these other things work. Totally get that. But that's an indicator worth keeping an eye on, given how accurate betting markets have become, because it's people putting their money where their mouth is, right?
Yep.
I think ultimately what Warsh has to do is a couple of things. Number one, you got to look past the oil shock, because it's a non-monetary problem and you can't fix it with monetary solutions. This was the mistake the Fed infamously made in the 70s, where during one of those oil shocks, they decided to hike rates, and it slowed the economy down even further, and it contracted the economy even faster than just the oil shock alone. There was no reason to tighten credit. Loose credit wasn't the issue. It wasn't you had this huge expansion in the money supply. It was you had a contraction in the amount of products and services available to purchase because of those higher oil prices. So again, the Fed needs to, as they say, look past this and say, what is the underlying monetary portion of this? And in that regard, I think the answer is to draw down the balance sheet. And it's not going to do any favors for equity prices, but it's what needs to be done. I mean, what we've seen out of the Fed for the last really quarter century, ever since the dot-com crisis, has been this, and they've done it through different mechanisms, but it's a way to try to re-inflate bubbles instead of allowing the economy to actually like work its way through, to have the recession, and again, to reallocate capital to where it needs to go. And this has been a massive wealth transfer from Wall Street, or excuse me, from Main Street to Wall Street, right? Wall Street got the asset bubble and Main Street got stuck with the inflation.
How quickly could when we talk about the Fed, we talk about the Fed selling off assets and draining liquidity from the system. How quickly could he start doing that? And how quickly could that really be, like how quickly do you think the market would discount that? What is the effect, the timeline of the effect of that?
Great question. It's probably got a long lag to it. If we go back to when Powell started running off the balance sheet, right, and then when you had the Silicon Valley Bank collapse, that took quite a while. If you look at when they first started running off the balance sheet right before Trump got into office during his first term, it's not until when's the repo crisis? It begins in September, really, of 2019. So again, you're talking about years. So some of it is going to have to do with the pace, right? The faster he's running off that balance sheet and selling off these assets, the tighter some of these money markets are going to become. So that's part of it. But the other thing, Anthony, is I think it's going to take him at least a whole meeting cycle, if you will, to get the rest of the FOMC on board. He's got to get the rest of the board of governors, some of the presidents of the regional banks to agree with his plan here, because this is going to involve a complete and total unwinding of basically everything the Fed has done since Bernanke, ever since the GFC, where they started paying interest on reserves. The whole thing's got to go. Because if all you do is you just are pulling one lever, these things are so interconnected. If all you do is just pull one lever or turn one dial, it's not going to work. It's going to cause more problems for you. And then it's going to be just Band-Aids on top of Band-Aids. Again, like the bailout for the hedge funds beginning in 2019, continuing until March of 2020 when COVID hit, or the regional bank bailout. We had a whole facility, a whole brand new lending facility. Remember the bank term funding program at the Fed that they had to invent? I mean, it was just, again, it's Band-Aids on top of Band-Aids. So my guess is it's going to take Warsh at least a whole meeting. So don't expect anything in this coming meeting in terms of definitive plans for running off the balance sheet. But I would suspect that after that, they will probably have a plan in place that will involve at immediately stopping the increase in the balance sheet and then a taper thereafter. It might not be a lot in terms of the speed, but that's my expectation. Perhaps they're able to quicken it as they start unwinding other things, in terms of money markets. But look, Treasury is not making it easy for them. That's the other complication. You're borrowing $2 trillion a year. That makes it a lot tougher to get rid of all these treasuries off the Fed's balance sheet.
Yeah. Now, we got news today, massive spike in the market. Everybody risk back on. First this morning said he was going to bomb them hard again tonight and take over Carg Island. And that kind of led the way to a completely opposite tweet, which said there was a peace deal signed. Markets ripped. Here's my question. That deal looks like, first of all, it's an MOU with a discussion on how to discuss nuclear. It's really not what was billed initially as the peace deal, the official deal. If we were to actually come to a complete peace agreement this weekend and the Strait opens up, we're talking about inflation, and that obviously has to do with energy. It has to do with all the raw materials stuck in the Gulf that need to get out of the Gulf and go to their client port, their customer ports. How long will it take for those supplies to get there and for that resurgence in the supply chain to actually start to draw inflationary pressures back down? When we're talking whether it's helium, crude, nat gas, what have you, how long do you think it will take for this to start to work its way back through the system and lower inflation?
It's going to take a while, Anthony. We have rapidly depleted. Here at home, we have the Strategic Petroleum Reserve as well as private stockpiles. Other nations around the world, same thing. They have public and private stockpiles for the most part, but everyone's depleting their reserves. We're burning through ours at an incredible rate. And then the other thing is we're going through not just what you might call reserves qua reserves, but we're using other things like supply chain cushions as reserves. And look at the Cushing, Oklahoma facility, for example. That's down to almost 20 million barrels, which sounds like a lot, but that's basically what a lot of people consider to be the operational bare minimum. So once you go below that, you can run into situations where these tanks are massive and they handle a lot of crude over the years. They get sludge and stuff on the bottom, and as the levels get lower and lower, you increase the likelihood of picking up some of that sludge, clogging filters. You also run the risk of are you actually going to have enough oil left in a tank to pump out for a delivery before, and are you going to be able to get all that done? Or I should say, is all that going to happen before an adequate refill happens? In other words, could you actually pump this tank dry before new oil comes in? So even though the whole facility overall has oil, is it in the right spot? I mean, look, the logistics here, and I'm oversimplifying a lot of it, but the logistics here are incredibly complicated. And so when you hear a number like 20 million barrels at this facility, that sounds like a lot. It's really not. And once you go below that, that's when you actually start running into some of these logistical headaches, and you start sometimes missing deliveries. At the very least, you see prices go really high, really fast. So again, we've been eating into all of these reserves, even in things like supply chains. The reason I say all of that, Anthony, is because all of this has to get refilled. So the supply shock is going to go away, right? That's the whole premise of the question here. The supply shock goes away. Great. All this oil's back online. Now it gets replaced with a demand shock. And so now there's this huge increase in demand because it's not just us, it's everybody around the world that's been digging through their reserves. Everybody's going to need to refill them. And now not everybody has to refill it all at once. You're not going to add these reserves back in at the same pace you took them out. I get that, but it is still upward pressure on prices. In other words, you're not going back to $60 a barrel anytime soon. It's just not going to happen. Yeah. You're going to have more demand than before the war, and you're going to have basically the same production. Sure, you've seen a little bit of increase in production here and there in different parts of the world, including the United States, but you've also lost production in the Gulf because of the fighting, right? Infrastructure has been damaged or destroyed. So let's say production is relatively flat and demand is materially higher. Yeah. That means higher prices. Now it'll probably be high 70s, let's say, instead of low 60s. So we're not talking $100 a barrel, but again, it's still elevated.
Yeah, I mean, everyone. Obviously we're not we trade crude here, futures, WTI, but we have a smaller basket of futures that we trade. But the guys that I'm in touch with and friends with that are at other hedge funds, whether they be equity or CTAs in the energy space and the material space, everyone has the same story. And even a lot of the brokers are out, the research is all the floor has been elevated. So if the floor for WTI was 60 pre-war, that floor is probably 80 now until this demand shock goes away and we reset. And that's assuming there's no other shock to the system and nothing else goes wrong. As far as the minimum reserves, that's actually really interesting to me. It reminds me of, when my dad always used to tell me, don't let your gas tank in your car get below a quarter of a tank, because if it does, you start sucking up some of the dirt in the bottom, the car's not going to run as well. And that's exactly what this sounds like. And we're at that spot now where, we're being warned. We had warnings from Chevron last week that they're seeing massive drawdowns in those reserves, and they're getting to levels that are beyond the minimum. And I think that probably, to be really not sarcastic, but to be a little suspicious in the timing of this particular announcement, we have cracks in the AI story developing as far as what the return on investment is. We have the AI giants now saying maybe we should slow down with development. Now we're talking about pricing, where they're actually talking today about lowering the cost of the tokens because they're just too expensive, as CapEx is exploding. So free cash flow is being drawn down excessively for AI. The AI companies are saying maybe we should slow down and we'll charge you less because it's too expensive. We're getting like kind of this spiral heading into SpaceX. So I feel like the announcement today was kind of energy levels and supplies are at a spot where something needs to be done. B, the market is starting to recognize a lot of issues beyond rates and inflation and the AI story being healthy or not healthy. We're starting to ask questions, which is good. And now we have the announcement that there's a peace agreement and it's going to hit, and it's sometime soon, and this is going to be it as we head into the SpaceX IPO tomorrow, which, market participants and those in charge would want the market to be healthy and have an explosive, rocket ship for the SpaceX IPO. And I think that's kind of what we saw today. I'm not really convinced that what we saw was a real deal. I'm not really convinced that what we saw is even an MOU that's going to mean anything. I think for the market, there was an explosion of risk on and short covering today. I'm not quite sure that we're going to see a continuation into tomorrow. And I know I pivoted off of reserves and the supply chain into this, but obviously all connected.
Yeah. Well, and Anthony, this is like, I think this is something that a lot of people want to know. How on earth do you trade in this environment, right? You started asking about what's going to happen in terms of supply chain and inflation, and you mentioned we're living in this crazy environment of, you get news in the morning of we're going to bomb the what out of Iran, and then a few hours later, after people have shorted the market like crazy, a few hours later you get an announcement, oh, by the way, we're on the verge of another deal, and things take off, and then we hear later, well, it's like a deal that we're going to talk about a deal. In other words, we're exactly where we were 24 hours, and we've had this extreme volatility.
Yes.
And the guy who's trying to trade on his own is you're going to get killed. You are getting absolutely murdered. So
I don't know anyone that's sitting at home on their E-Trade or TradeStation account that's doing well. We have a full team working here, and we have a ton of research, and we have our models, which is systematic, and we're struggling with the headline risk and the volatility just within the day. Forget VIX and vol, because that's kind of broken, which is another story. But it's extremely difficult to trade. I'm considering wearing a helmet to work from now on until this is completely done. I actually have my old football helmet from college, so I might actually wear that. I think the overarching theme is you have to assume that whatever's going to come out of the White House is bullish. And, they don't want Trump. President Trump had the right idea, and I think we're in Iran for the right reasons. I'm not going to compare it back to weapons of mass destruction and President Bush and Iraq, but if you wanted to compare it to those two things, I think we had a legitimate reason to be where we are. I think we got to a spot where the game didn't necessarily play out exactly as we thought. My feel is that we initially thought that we would go in, bomb the heck out of them, put them on notice, lock them down, and then there would be an insurgence of the population that would actually take over their government and re-import democratic leaders to lead the Iranian people. And that didn't happen. And I think that we got stuck in this kind of these Chinese handcuffs of, well, now the Strait of Hormuz is closed. We didn't kind of see that coming. What do we do? And how can we keep bombing them? And all the things kind of spiraled. So the headlines, to circle back, are very disruptive. They're very frustrating. I think everybody in the institutional world, hedge funds and buy side, sell side, everybody's pretty frustrated with the market and the way they whip and turn. You could be right 100% in your technical analysis. You could be right 100% in your fundamental analysis. You could be positioned really well, and you will get ripped in the moment because of a headline. Whether or not it's true, to your point, we can come in tomorrow, tonight, and this could totally not be true. Iran and Israel came out 2 hours after Trump's tweet and said, we have no idea what agreement he's talking about. We haven't seen it. And then an hour and a half later, Iran came out and said, oh yeah, we've seen it. We'll probably agree to it because we wrote it. I'm like, my head's going to explode. I'm not really, at times when we can de-risk, even if we don't want to, we de-risk because there's no way to control the risk of massive random unknowns. To that point, we'll keep pivoting, EJ. It was an awesome segue into the weekly chart that we've been showing of the S&P. We've been on this chart now. We've been on this chart since late January. And what we've seen here as we've run through is, let me pull mine up here. In late January, we were talking about a breakdown in momentum. We had about a 7,000, 7,050 level in the S&P. And we had 6,400 and 6,600 and 6,400 as our downside targets on a measured move out of what I identified as an ascending wedge and retracement levels coming off peak to trough. We hit both of those targets, 6,600, 6,400. We actually, and this is crazy, but we actually hit a low in these front month generic futures, which is what I'm using for the chart. We hit a low of 63.53.25 off of our 6,400 target, which was put in place in early February. So really happy with that trade. That March was a spectacular month, very happy and blessed that we had it. We were ahead of that. And then we had this massive rally. So what I started to do in the chart that you see here is I started to run some regression and retracement of the trough to peak and how far out we extended. Pretty basic stuff, but stuff that maybe not everybody's looking at. The week of April 24th, we had a shift to positive in momentum on the weekly, which takes a little while. We were neutral prior to that, so that was a spot where you could have been long earlier. But week of April 24th, we get long. And I called about 2 weeks ago, maybe 3 weeks ago on the show, that we would potentially get up to the 7,500, maybe 7,600 level on this rally. So on this rally, last week we saw a high of 76.32.25, so right in line with where we wanted to be. And we subsequently sold off about 5.25% peak to trough through this week. What has kind of held that sell-off now was the announcement today on the peace deal. And we got a very, very aggressive 1.75% rally in the S&P today. And it was an S&P that was kind of stuck in the rut for the day. We had the NASDAQ down. NASDAQ was down almost 2% on the day. NASDAQ futures closed up 3.1%. So you're talking about a 5% swing based on an announcement on a deal that might not really be a deal, that may or may not get signed type stuff. So for me, if we're talking about the market, the headline risk is a challenge. I think we've seen the high for the market for now. I do think that the sell-off will continue. I think there'll be some euphoria heading into SpaceX tomorrow. I think it's going to be a really awesome thing to watch. We don't trade cash equities here, so I will be watching SpaceX. I will be interested in how it affects the futures market's overall risk appetite overall. I'll be interested to see if the Mag 7 drawdown we've seen has really been a cap raise to actually head into SpaceX. I agree with that to some degree, maybe not as much as we've seen, but to some degree. I think we've seen the highs. I think SpaceX will be a shakeout tomorrow. And then I think this peace deal really is, it's important because we're at in the Russell and approaching in the S&P long-term resistance and major resistance now for these indices. We're going to need more than this type of announcement to push higher. and we're going to need more from the AI story that there really are, the cracks are not there, and it looks like people are starting to really question it. So big IPO tomorrow. Keep an eye on the levels. 75, 7,600, I believe, will hold as a top. Even if retested, I don't think we break higher from here. If we see a change in momentum, that's great. If trend improves, that's great. I'll be the first one to say we're going higher. But as of right now, we've gotten some technical damage and some cooling off in the market. I do believe there's more to come. I would say at a minimum on this move down, we're at essentially 7,400 front month futures. I'm personally looking for a 7,000 target on the way down. That may or may not come before a retest of 7,500, 7,600. But I do believe before we see higher highs from there, we will see 7,000 first. And then it depends on how aggressively we get there and how much breaks on the way down as to whether that will hold or not. But just be cautious here. I think the sell-off that started, you can kind of pause it a little bit with these headlines, but I don't believe that sell-off had as much to do with Iran as it did with the expectations of higher rates, the expectations of an inflation issue, the expectations of cracks in the AI story, and us kind of being over our skis a little bit here with the entire semi-tech AI trade.
Yeah, and again, you get, let's say you actually do get a peace deal, right? And you start testing those highs again.
Mm-hmm.
None of that changes the fact that so much of what we talk about in terms of the underperformance of some of these AI companies and the way the very clever accounting, let's put it that way, that they use to say all of this massive upfront revenue we're getting from subscriptions, we're going to extrapolate that to the whole year, right? This doesn't change the underlying inflation story. That a deal is great. We still have huge price increases that are baked into the cake, right? It doesn't solve any of the underlying problems. Is that fair to say?
It's fair to say, and it's very important to say that the logical longer term discounting and reaction to this stuff is not necessarily what the market will do in the here and now. So, the old saying is the market's never wrong. The market's never wrong. You're wrong, but the market's never wrong. And it's timing, right? So that's a very fair statement. However, the market could decide to discount that at a later point and just continue the march on. So I think that's the thing that, when you're managing risk, you're managing a fund, you're managing positions, you need to be conscious of the fact that what you see moving out into the future isn't always what you're going to see right now. And you have to find a way to manage around that, continue to make money with a market that may not be doing at the moment what you think it will eventually do, or figure out a way to be longer dated in positions where you can take advantage of those moves later versus now, because the now may not be the right, but it's right for right now. If that makes any sense. It's actually,
No, it
I'm going
does.
to bring this up and then I'll wrap it up. I don't want to continue to kill you, but I got a great chart today from a research house on the hyperscaler free cash flow projection. That free cash flow for Amazon, Microsoft, Google, Meta, Oracle has gone from, in the 2025 peak, we were at, round numbers here, about $300 billion. Okay. That free cash flow has plummeted to $25 billion.
Whoa.
As the S&P has reached all-time highs. As these stocks, Amazon, Microsoft, Google, Meta, Oracle, have accelerated up to all-time highs or near all-time highs and now are taking a nick on the way back down. So this is part of why I'm saying I don't think that these names and this drawdown is necessarily a cap raise for SpaceX. It makes sense to me to some degree, it does. But I don't think that it's totally what's going on here. I also don't think that the Iran story, the headline of it is, I think the reactionary effect to the market is not necessarily the way the market's ultimately headed now. I think today's pop is great within a larger move developing lower. And that move developing lower has more to do items like this and the fact that we don't know what the cost of the tokens are or what the return on investment for each token is. These are important things and we don't have the answers yet, but we keep piling money in because everyone feels like if you're not on the train, you'll miss it, which is great, but you're destroying your free cash flow. Look at Google. Google now out to the debt markets and now issuing stock for more money. So Not that that's not necessarily a bad thing for Google or a bad approach because of the price of the equities, and I get it, but it's still, there's an awful lot of money being spent here and cash being burned here on something that we still haven't identified the actual benefit of or return of investment on. And I just think that's something that the market is going to come to terms with, and that may result in a down 5 to 10 to 15% resettling, or that may result in a complete turnaround in the market and a breaking of the narrative and a 50% sell-off. My job is to identify which one we're in and profit from it as much as I can for my investors, doing the best I can there on that, and handling that, and then juggling the headlines is my day-to-day challenge. So it's been a great episode. EJ, thank you very much. I appreciate it. I think we're going to see each other soon, I hope. I know we're traveling back and forth between DC and New York and Philly, so hopefully we'll see each other soon. I appreciate it, man. All good stuff, all good insight, as always. At Real EJ Antoni, you're the man.
Hey, pleasure's all mine. Anthony, and yours is CMT_Anthony, right?
At CMT_Anthony or Ascalon6capital.com. And the 6 is VI, it's a Roman numeral. But that's it, my friend. Have a great night. Thank you very much, and I will talk to you soon.
Until then.